To understand why you are bad at trading, we have to go back. Way back. Imagine you are an early human walking through the savannah. You have two primary goals. Goal 1. Find lunch, which is a gain. Goal 2. Don't be lunch, which is a loss. Now, let's weigh these two outcomes. If you find a berry bush, a gain, that's great. You get a dopamine hit. You survive another day. It is a positive outcome. But if you mistake a snake for a stick, that is a loss. You die. Game over. Your genetic line ends right there. Nature, in its infinite wisdom, realized that these two outcomes are not equal. Survival is more important than flourishing. Avoiding death is infinitely more valuable than finding a slightly better dinner. So, evolution built a bias into your brain. It wired your amygdala, the threat detection center, to react twice as fast and twice as loudly to negative stimuli as it does to positive stimuli. This is not a theory. It is physiology. When you see a threat, your cortisol spikes instantly. Your heart rate jumps. Your vision narrows. When you see a reward, you get a nice, warm, fuzzy feeling, but it is gentle. It is negotiable. The equation is pain is urgent and pleasure is optional. For 200,000 years, this was a perfect system. It kept us alive. The paranoid ancestors survived, and the optimistic ones got eaten. We are the descendants of the paranoid. But then, about 400 years ago, we invented the financial asset trading market. We took this ancient threat detection software and we plugged it into a game of numbers. And suddenly, that survival mechanism became a liability. Because in the market, loss doesn't mean death. It just means data. But your brain doesn't know that. When you see a red candle on a chart, when you see your account balance drop by $1,000, your amygdala doesn't see financial variance. It sees the snake.